All right, so let's talk about capital budget revenue sources. Overall, we can look at a lot of different sources for our capital budget projects. We can look at bonds, we can look at taxes, lease purchases, transfer taxes, dedicated fees, and overall just general old fashioned financing. So, the first area we'll look at is bonds. So, these are traditional sources of capital improvement funding across a wide range of projects. You can borrow a very large sum of money. There's minimal impact on your taxing ability, and it's usually a pretty immediate funding source. So some of the disadvantages, it may increase property taxes. Sometimes it can compete with local services or other local projects, and it really does separate the payment from the benefit as far as they're separated in total. Then we can look at what kind of bonds are out there, and there's a wide range of names and styles. But we'll just cover serial bonds and term bonds here for right now. We're going to look at the source of revenue bond for repayment, which is a serial bond, and then look at the method of retirement, which is a term bond. So, a serial bond is where regular payments are made annually on the principal and the interest. The interest rate is generally very low and it's guaranteed by the taxing authority, so to speak. This usually works much like a home loan where you've got payments that are equal across the board until it's paid off. In the beginning, you pay a higher interest amount and lower on the principal. And as you move forward through the term of the loan, your payment toward your principal increases and your payment toward the interest decreases. So your highest payments are usually made when you have the facility or the operation or the endeavor is new and you're creating a lot more revenue generation. So there's two ways to look at this when you look at a serial bond and a straight serial bond. So with a serial bond, so the total paid is the same every year. You have a low principal payment toward the beginning and a high interest or principal payment toward the end. So as you pay on, the amount that goes toward interest and principal fluctuates during the term of the bond. The straight serial is where you pay the same amount of principal every year, and your total interest paid depends on how much principal you have. Then we can look at serial annuity bonds. This is where you have an equal payment each year until the debt's paid. The interest rate in the early years is higher and then decreases over time. So your payment on the principal is lower at the beginning and higher at the end of the term. So I've been saying term, and that's just the life of the bonds. But then we can also look at a term bond. A term bond is paid off with a single payment at the end of the loan period. So there's a sinking fund that can be established where funds are deposited and they accrue interest. And there's a guaranteed payment at the end of the borrowing period. Then we'll move on to general obligation bonds, and you'll hear this term a lot as well. This is where it's based on the sources of revenue for payment. So, for building a recreation center, we use revenue from that recreation center to make the payment on the debt. So, it is issued by a public agency, and the expectation is that whatever is being done benefits the entire community in some way. Again, this is a very common model for attaining financing for these large projects. General obligation bonds are pretty attractive because they're exempt from federal income tax. They're also a secure source of investment for buyers, so they know, or investors, they know that they're going to get repaid. Sometimes this can result in an increase in taxes across the board for the guarantee of the bond. If we look at revenue bonds, these are used to finance a revenue producing facility. So we can look at aquatic parks, recreation centers, ice arenas, golf courses, anything that we're going to seriously accrue some revenue. So it requires significant or sufficient revenue to pay off the bond and cover all the facility operations at the same time. Okay, so let's look at tax increment financing. This allows public agencies to secure financing for projects with within a certain political boundary. It's frequently used for redevelopment projects, so like downtown areas and the like. It works within a fixed boundary, and property owners within that boundary pay an additional property tax. So again, let's think about like downtown areas where local companies or business owners, as maybe some residents as well, have increased tax load to redevelop an area. So usually the focus when this kind of thing is to redevelop or improve the quality of life in a neighborhood or area. And the intent is to bring in new development or significant remodel, that kind of stuff. It can include freezes on property taxes for an area. And the payment made from additional sales tax, personal income tax, increased assessed value of property is usually where the money comes from. And then we can look at bond banks. So this is a bank organized at the state level. It allows government entities to pull bond requests to secure better interest rates. So we're looking at leveraging interest rates. The state issues the bond, and they have a high interest rating, which is lowering the cost of the bond. And what we mean by high interest rating means because it's so secure, the interest paid is lower. So it's going to lower the overall cost of the financing. So lease purchase certificates are things you may not have heard of as much. This is when a public agency joins with a private source to finance major projects. So you might have heard of a P3 or a public-private partnership. So here, a nonprofit holding corporation is used as a way to avoid a public referendum. So these two entities come together to form a nonprofit, so to speak. They can purchase and develop any property. So oftentimes you'll see that the public agency is going to lease to the nonprofit, or the nonprofit is going to lease to the public agency. And whatever revenue generated is used to pay the cost. When the debt is paid in full, usually the facility or the area is given to the public agency, and the nonprofit, if it's formed, is usually dissolved. Again, this is the popular term right now is the P3, public-private partnership. Then we can look at a real estate transfer tax. So this tax is based on the sale of certain classes of property, residential, commercial, industrial, whatever it may be. The tax typically increases with the size of the property. So as the size increases, so does the tax. The revenue is collected at the local level, if we're talking about municipal and county. And the taxes are often used for community development within those boundaries. So we're thinking about parks, recreation centers, ball fields. All right, we'll finish the discussion here with a very common example of a special tax. And this is called the bed or the lodging tax. And this is when you stay the night in a hotel, you pay a small tax to the local government, whether that be city or county. The funds from this are used typically on tourism and tourism development, but we can also use them in other ways. There's a variety of other things we can use them for. The benefit to this is you have people that are coming through your area, so people staying the night at the hotel, so you're taxing somebody from outside your geographic boundary to improve your inside the geographic boundary. And that concludes our capital budget revenue source discussion.